Good afternoon, viewers. In the last class, I told you about this accounting vouchers. Accounting vouchers are the vouchers that are prepared by the accountant, and these accounting vouchers are to be supported by some vouchers, and those are known as supporting vouchers. Supporting vouchers are two types: internal vouchers and external vouchers. That is, internal supporting vouchers and external supporting vouchers. So, what is internal supporting vouchers? Internal supporting vouchers are those vouchers which are prepared by the accountant, and these internal supporting vouchers they will be affixed to the accounting voucher as a confirmation. External vouchers are the bills, various invoices given by outside people to the business, and these external supporting vouchers also to be affixed to the accounting vouchers, okay, for confirmation and for clarification. Now coming to accounting vouchers. Accounting vouchers are of three types: debit voucher, credit voucher, and transfer voucher. What is debit voucher? Whatever it may be, the payments that an accountant is paying, accountant is giving, it may be by the accountant or by any other person. When he is making a payment of cash, okay, naturally we will go for debit voucher. That is, the accountant he will prepare the debit voucher. Credit voucher, when any income it is coming to the business, and any person when he is receiving, then we have to prepare the credit voucher. Okay, stating that some amount is coming in. Transfer vouchers, for transfer of some expenses to some liabilities or assets, we will go for transfer voucher. For example, interest on capital and depreciation. Interest on capital is nothing but the reward given on the capital invested by the businessman, and he will get his amount only after closing of the business. So, up to that extent, as a reward for the investment made by the businessman, some amount the business will give to him as a reward. So, that is nothing but interest on capital. Depreciation. So, when we purchase an asset and when we are using continuously, actually some amount, some value of the asset will come down. So that amount will call that thing as depreciation, and this depreciation it should be transferred to the asset. So like that, transfer vouchers you will come across when you deposit cash from one bank to another bank, when you transfer some amount from one bank to another bank, or when you are drawing money from the bank, okay, then transfer vouchers are to be passed. So like this you will come across accounting vouchers. And after accounting vouchers, one important aspect is accounting principles. These are very essential when you go for the subject accountancy. Accountancy principles, okay, we will have 14 accounting principles, and these 14 accounting principles, like how you come across 14 principles of PAL in business organization and management. In the same way, the accountancy subject also it is having 14 principles, and out of the 14 principles, 10 are the concepts and 4 are the conventions. Concepts means the rules and regulations that every businessman or every accountant, wherever he may be, at whatever it may be, the nook and corner, they have to follow this. So those are nothing but the accounting concepts. And now after that, four conventions are there, and these are nothing but the guidelines for the accountant to follow in that manner, in that way. So those are nothing but the conventions, accounting conventions. Now what are the 10 concepts that we come across? First one is business entity concept. Business entity concept, that is, how a business, how a person, how an individual is having identification In the same way, you have to identify the business. That is, you should not think that I am the business and my business is myself. You have to see your business as a separate person. That is, it will have its identification. Then only you will come to know about the profit amount or loss amount that you make from the business. So you have to identify the business as a separate person because it is a separate legal entity. So that's why you'll come across business entity concept. Okay. Second one is going concern concept. Okay, whenever any person says, how is your business? It's going on. You should say always going on, but you should not utter the word, my business had gone. Because when you utter, people will have the idea, people will think that when you, when the proprietor, when he himself, when he's telling that my business had gone, so no one will have confidence on that business. No one will come to the business and purchase the commodities. So, wherever it may be and whomever it may be, whatever it may be, whenever it may be, you have to say that my business is going on. Okay, like that you have to tell. But you should not say that my business had gone. So, going business, going concern concept, that is one important concept that we come across. The next one is money measurement concept. Money measurement concept. What do you mean by this thing? Okay, like how we are having measuring rods, measures for liquids, distance, okay, weights. Okay, in the same way, money is used, money is measured as a measuring rod for any business. Okay, how much money is getting, how much money is losing, all these things in terms of money only he has to see, but he should not go for any other measurement. For example, when you go for distance, when you go for distance, you will take into account meters and kilometers. When you go for liquids, liters and milliliters. When you go for weights, okay, kg and grams. In the same way, whatever it may be the business transaction that you come across, that you do, you have to measure in terms of money only. That is nothing but money measurement concept. Now, three concepts are over. Now, fourth one is cost concept. Cost concept. This is very important concept, and basing on this concept, the businessman he can be in a position to know how much profit he is getting and how much loss he is incurring. Okay, there is lot of difference. There is lot of difference in common difference between price and cost. But in common man's language, both are one and the same. But when we go for accountancy, there is a feather type, feather type difference between the cost and the price. Cost is nothing but the total amount spent, the total amount spent for making the commodity from rock stage to cream stage, from raw material stage to finished goods. That is nothing but the cost. And price is nothing but the value of the product at which we will get the commodity. So that is the thing. So price minus cost is equal to profit, or cost minus price is equal to loss. So every businessman, he has to keep his eye, he has to keep his concentration on the cost of the product. When he comes to know about the cost of the product, then he can be in a position to know the profit amount. That is, whenever you reduce the cost, automatically the profit amount will increase. Whenever you raise the cost, automatically you are going to incur losses. So cost concept is very important, and every businessman, he has to look after the cost of the product. It is not the price of the product. Price can be fixed afterwards, but cost is very important for any businessman when he is going for selling or purchasing the commodity. So cost concept is over. Now, after that, accounting period concept. Accounting period concept means every businessman, he has to stop his books. Okay, he has to stop his books of writing, books of accounts for, for a particular period of time. For a particular period of time. Then only he can be in a position to know the profit amount or loss amount. Suppose if he won't stop the books at a particular time period or a specified period of time, then he cannot be in a position to know the correct profit amount or loss amount. So we have to, every businessman, they have to stop the books of accounts after a particular period of time. So that is nothing but accounting period concept. Generally, accounting period concept, it takes into account only 12 months duration. Okay, only 12 months duration. That's why people previously they used to follow the calendar year. That is, they start from December and they ends with, they starts with January and ends with December. But later on, taking into account the income tax authorities, what they have done is they shifted that. They shifted that and they start from 1st April of a year and they ends that by 31st March of the next year. Different people, they used to follow different periods of time. Okay, some people they used to keep Diwali from Diwali to Diwali, like that. But the procedure was completely removed. They completely changed, and according to income tax authorities, okay, they used to follow this period of time. That is, 1st April of one year to 31st March of next year. So like this, the accounting period concept is there, is introduced. Thereby, people they can be in a position to know the correct profit amount or loss amount. This is about accounting period concept. This is the fifth concept that we come across. Next concept is matching concept. That is, whatever it may be the expenses, whatever it may be the incomes that we come across in that accounting period, we have to match with that accounting period only. We should not carry them to the next accounting period. So that is nothing but matching concept. So whatever it may be the expenses incurred in that year, they have to be matched with that accounting period only, but not to the next period. So that is about matching concept. So five concepts are over. Now coming to sixth concept, accrual concept. Accrual means added concept. That is, when you cannot pay or receive whatever it may be the expenditure or whatever it may be the income, and when you keep that aside, okay, when you keep that aside, the next year whatever it comes, whether it may be an expenditure or whether it may be an income, it should be added to the first one. So that is nothing but accrual concept, that is added concept. Okay, at whenever you are having enough this thing, then only you can clear that. For example, depreciation. Suppose if you don't want to charge depreciation, if you think that when I charge depreciation the profit may reduce, so what you will do is you will provide provision for depreciation, like that you will keep separate this year, and next year also you will come across depreciation. That amount also it should be added to the previous amount which was kept separately. So that is nothing but accrual concept. Okay, so after accrual concept we will have dual aspect concept. Dual means two. Okay, dual means two. So that is, every transaction will have two important aspects, receiving aspect as well as giving aspect. So when you go for a transaction, when you want to record the transaction in your books of accounts, then you have to take into account both receiving aspect as well as giving aspect. Who is receiving, who is giving, what is coming, what is going, what are the expenses, what are the incomes. So everything you have to record. So that thing is nothing but dual aspect concept. Okay, seven concepts are over. Now coming to the eighth one. The eighth one. Okay, what is that eighth one, sir? Okay, the eighth one is the realization concept. The realization concept. What is this? Whatever, suppose if you are doing a business and if your business is not running on sound lines, then what you have to do is you have to leave the business and you have to shift to another business. When you want to shift, whatever it may be, the assets that you are having, they should be resellable. They must have realization value in the market. So that is more important. Realization, okay, realization concept. That is, whatever it may be, the assets that you are having, they should be resold in the market, and with that amount, whatever it may be, the amount that you are coming across, that you are coming in, you can be in a position to clear the liabilities. That is realization concept. Okay. Next, after that, we are having one more concept, that is objective evidence concept. What is objective evidence concept, sir? What objective evidence means? Whenever you are doing any work, whenever you are doing any work, then there should be an evidence for that. So that is nothing but objective evidence concept. People, they will look after. See, you are doing this. Okay, you are doing this. So where is the evidence for that? For example, just I'm giving a small example. Suppose if you are selling a commodity. Okay, where is the guarantee? Where is the proof that you sold the commodity? So, sir, the sales invoice I'm having. I had given the sales invoice to the purchaser, and one copy I'm having. So this is nothing but the evidence for the thing. Okay, that I have sold the goods to another person. Like this, you will have 10 concepts. Okay, 10 concepts. And after this, you will have the conventions. What are the conventions? Okay, there are four types of conventions. These are nothing but the guidelines. These are nothing but the guidelines for the accountant or a businessman to follow the concepts thoroughly and carry on the business on smooth lines or sound lines. So, what are the four conventions? Convention of consistency, convention of materiality, sorry, convention of full disclosure, convention of materiality, and convention of prudence or conservatism. These are the four concepts that we come across. Okay, convention of consistency, convention of material full disclosure, convention of materiality, and convention of conservatism. So consistency, see, when you are going for this business, you must be consistent. You must be consistent. That means you should follow, when you are following one method, you have to follow the same method. Okay, suppose if you want to change the method, in advance you have to inform that to all the people who are in touch with you, who are in touch with you. Sir, I am following this method up to now. Now I want to change. I want to shift from this method to this method. So whenever you give a prior notice or notice in advance, then people, they can able to understand. Without giving notice in advance, when you change the method, people, they cannot able to understand. So consistency is very, very necessary. That is, you must be consistent, whatever it may be, wherever it may be. Okay, I am going to follow this method and I am going to follow that method, and you have to follow that method. Whenever you want to change, you can change by giving a advance notice to all the people who are in touch with you. That is nothing but convention of consistency. With this, I am just going to close, and in the next class I am going to continue this. Thank you.